All right. Welcome, everyone, to Value Investing Live. Today, I'm pleased to welcome our guest, Jason Crawshaw, Portfolio Manager at Polaris Capital Management, LLC. He brings almost 2 decades of experience to the team and is a generalist conducting fundamental analysis of potential investment opportunities. As always, for those of you out in the audience, do please feel free to post your questions, comments, anything like that in that chat section throughout the presentation. But do keep in mind we are going to hold those questions until we get to the Q&A at the end. Without anything further from me, I'll go ahead and hand things over to Jason here. We can jump into the presentation.
Great. Look, thanks so much, Graham, for the introduction. I certainly look forward to spending the next hour or so with the audience and appreciate their time. I think what I'll try to do and achieve is give a little bit of an introduction to Polaris, talk about why our style of value, I think, is very different than other value managers. We'll spend a lot of time on the process because clearly that's critical to what we do. I'll give you actually a couple of stock examples because I think that'll be really helpful to sort of put some flesh on the bones and give you a good sense of the kind of companies and opportunities we look for here at Polaris. And then I just want to leave plenty of time for Q&A at the end. Certainly looking forward to a lively discussion. Before we get going, maybe just a little bit about my background. I've been here, this is my 8th year at Polaris. I'm actually South African originally. I'm sure the accent is long gone. But I essentially grew up in the States, but after getting out of business school, went back to South Africa, worked down there from 1994 to 1998. And you can imagine as a young equity analyst, it was really interesting time to be there, both in terms of the changes going on in the country, but also the changes in the economy and the capital markets. I've spent almost the entirety of my career working in the global value space, very much always a bottoms-up fundamental equity analyst. And, I think Polaris, I'm very fortunate to work here. It's really a unique place, a unique culture. And I hope to really demonstrate that we think it's a different process over the next 40 minutes or so. A little bit about the background. The firm itself was founded in 1995. We are quite fortunate in that we do have a healthy asset base. We are a global investment boutique based in Boston. And in terms of a boutique, what that means to us is we are really focused the entirety of our activities on the investment side of the equation. We never set out to be asset gatherers. We're not marketers. We don't have internal distribution. We want to basically find the best available investment opportunities anywhere in the world and create the best risk-adjusted portfolio. What that means is we've outsourced or formed relationships and partnerships for things that we consider as non-core to the investment process. In terms of marketing and distribution, we've been fortunate. We have some great partnerships both in the U.S. and on a global basis to manage that side of the business for us. And we also have outsourced our back office for the better part of 20 years. We are fully aligned with the clients. We clearly fully believe in what we do. And what that means is we have almost all the individuals here have really almost the entirety of their net worth invested alongside the clients and in the firm itself. We are 100% employee owned, and we certainly aim to stay that way. The process, I'll talk about in a little bit, but clearly the one thing, if I can leave you with today, is the only thing we care about here is cash flow and cash flow generation. So you'll hear me spend a lot of time talking about cash flow, and that's something we really fixate on. The track record and the performance, I think we have a fairly lengthy one, given the firm was founded in 1995, but the actual track record goes back to, I believe, 1984, where the president and founder, Bernie Horn, started managing global value portfolios. And it is a 38-year GIPS compliant track record. I think that's important, the longevity that is, because we've certainly seen good markets, bad markets, the dot-com bubble, the Japan boom, the global financial crisis, the COVID pandemic, and we can really demonstrate how the strategy has performed under various market environments. In terms of Bernie, 38 years worth of track record. His goal is to have a 50-year track record. But I think more importantly, the actual process itself is a collective process, and the portfolio is team managed. In terms of what we do and how we do it, quite frankly, the return objective is 200 basis points of excess return on an annual basis with lower than market risk. And we define this as having a cumulative rolling beta of our portfolio relative to the benchmark of 1 or below. And just keep these two numbers in the back of your mind, because we actually integrate these two metrics into our valuation framework. As discussed, the only thing we care about here is cash flow. We believe companies exist to generate streams of cash flow, and then take that stream of cash flow and either reinvest it back into its business, if they can do it at a high rate of return. And if they can't, we need to see it come back to us in the form of a dividend per share buyback. Being a value investor, and admittedly, I've worked at some value shops in the past and some very good ones, but I think one of the traps that value investors often fall into is they define value on so many different metrics. And it might be price to tangible book, it might be EV to EBITDA, it might be some sort of cash flow metric, it might be a sum of the parts, it might be a take private metric and the like. And I think when you have all these multiple metrics, what you often do, and I would sort of observe this in my prior experience, is you would have analysts or portfolio managers essentially see a stock that would sort of look optically cheap, and then cherry pick which metric they would use to justify why I'd get into the portfolio. I think the challenge with that is you have really a hodgepodge of investment ideas that constitute a portfolio, with no real consistency or characteristics around sort of what a company should look like, no consistency in process around how you value the company. And so you really have a very disparate or inconsistent both valuation and investment process itself. By focusing on cash flow and cash flow only, we think we have a couple of really important outcomes. The first is that everyone on the team understands exactly the kind of companies that we're looking for, what they should do, what characteristics they should exhibit, and they know exactly basically how we're going to value it at the end stage. And so it really leads itself to a consistent, repeatable, and sustainable investment process over time. And when you're doing something for 35 plus years, and we aim to do it for the next 35 years, it's really important that you just have this continuity of process. So I think that's critical. I think the other thing I'll just talk about here at a high level is, we are looking for, call it the 75, maybe to 85 best companies anywhere in the world, any geography, any sector to constitute a portfolio. We're creating this from a bottoms-up basis. We are completely sector agnostic. I think as Graham referenced, we're all generalists here. Because we don't want to be biased in terms of having a certain sector or focus or expertise and lead our thinking down one path. For example, I guarantee you, if we had call it a Japanese pharmaceutical analyst on the team, they would be incented to get a couple of Japanese pharmaceutical companies into the portfolio, whether they were the best 75 stocks on a global basis or not. And so we really think having this generalist lens is really, really important to keep us completely unbiased and agnostic, because at the end of the day, we're just looking for streams of cash flow that we can identify, that are consistent in their behavior, that are repeatable, preferably low volatility, and that we can buy using our discount rate, which I'll talk about in a couple of slides. I think the other thing at a high level that I just want to reference is that we are multi-cap investors. We are, again, agnostic in terms of where we play in the market capitalization. We historically have seen, call it, roughly half the portfolio of small and mid-cap stocks, and the other half might be large-cap stocks. But again, that is driven from what we see on a bottoms-up basis, not some sort of top-down construct. And lastly, we're long-term investors. We like to think about when we assess any investment opportunity, that we're looking at a 5 to 10-year investment horizon plus. There are certainly things that we've owned in the portfolio for the better part of a decade. We want to invest with companies through business cycles, companies, again, that generate cash flow consistently, are good capital allocators, good management teams, And we understand, look, there's going to be some cyclicality to every company's cash flow. We manage a business here. Our cash flow can go up and down monthly, quarterly, annually, like we really want to make long-term decisions. As a result, that often means that the portfolio is fairly low turnover in nature. And I'll talk about how that manifests itself in the process further on. Okay, in terms of, this is really the last step in the process, but I'll talk about it first because it's really how I think we have a very different way of thinking about value and defining value relative to our value peers. We use a discounted cash flow methodology. And in fact, I would call it a modified DCF because it's not a traditional DCF. And this is really the numerator. This is our cash flow that we're going to discount back over some period of time to decide whether a company is good value or not. And instead of using free cash flow in our numerator, we use this concept called maintenance cash flow. And the way I would define that is very simplistically, let's just say cash flow from operations. And for the purpose of this exercise, think of that as net income plus depreciation and amortization. And then just assume working capital neutral just for a moment. And cash flow from operations, fairly standard accounting term. You can find it on any 10K, et cetera, and the like. There's nothing revolutionary about this. Minus maintenance CapEx, which is obviously not a standard accounting term. This is really a proprietary, it's a Polaris term. And the way to think about maintenance CapEx is the amount of capital that needs to be reinvested back into a business to keep cash flows constant in real terms. And when I say real, I mean after inflation, inflation adjusted. One of the things that we are sticklers for here is thinking about everything on a real basis because, if we're taking money from a pension fund, they have liabilities that are inflating at some rate, we want to give them a real rate of return. And so when we look at any company, we always think about, what do their cash flows look like on an inflation adjusted basis? And, that might not seem important for us sitting here in the U.S. where inflation is, fairly low. But if we're investing in a South African company or a Brazilian company in higher inflation environments, it's really important to think about, well, what do those cash flows look like after inflation? Because at the end of the day, that's what our clients' liabilities may be satisfied in. And so we really think about this concept of real terms. So having said that, if I could just give you sort of a formulaic example to further explain it. Let's say for a company, a cash flow from operations were 100 million, right? And total CapEx for that given company is 50 million, right? In a traditional DCF, free cash flow would be that 100 million of cash flow from operations minus 50 equals 50. So that would be a numerator. But what we want to do is we actually want to look at this 50 million of total CapEx and through both quantitative and qualitative analysis, tease out, how much of that is maintenance CapEx, i.e. reinvested back in the business to keep cash flows constant in real terms, versus growth CapEx. And through our analysis, we may determine that 30 million is maintenance CapEx and 20 million is growth CapEx. And what that means is, therefore, when we think about our numerator, our maintenance cash flow, it's 100 minus 30 million of maintenance CapEx equals 70 million, okay? And the first question or the first observation the audience usually makes, well, they say, well, that doesn't sound conservative at all because your 70 is higher than 50, so aren't you inflating the net present value and the value of the firm? And the way we justify this or rationalize this is we say, well, because we're not penalizing for this 20 million of growth CapEx, when we build our detailed financial model, and what we typically do is we build a detailed income statement, cash flow, balance sheet analysis, in very detailed Excel model, years 1 through 5, and then we use a terminal growth rate, 6 through year 50. We use a 6 to 50 year DCF. Because we're not penalizing for this growth CapEx, we won't grow the cash flows typically at a rate greater than 2%. And how do we get 2% off maintenance CapEx? It might be because you might get 1% global population growth. You might get 1% productivity growth. And so maybe you get to 2% for any given company, with this maintenance concept, CapEx concept. Having said that, we don't automatically award a company a 2% growth rate if the company is unable to grow 2% off maintenance CapEx, or if it's, and it's a very competitive industry, or it's in a structurally declining business. It might be 1%, it might be 0%, it might be minus 5%. We'll obviously adapt the model to the economic reality of that company. But the point is, the way I like to think of it, or think of it a different way, is when we're trying to assess or value a company, we just want to value the maintenance cash flow and ability of that business, right? And that's what we want to pay for. We certainly like companies that can grow their cash flows. We just don't want to pay for any of that growth. And so in the Polaris world, what's a little bit different as an investment professional analyst, and when I kind of speak to my peers, or I've worked other places in the past, let's think about this 100 million of cash flow from operations. Most people will think about a company, okay, well, that 100 million today, how can they grow to 105, or how can they grow to 110, and what do I pay for that, right? We just flip this equation on its head. We say, look, sure, it'd be nice to grow to 102 or 105, but my biggest risk is, or biggest focus is, the sustainability of this 100, all right? If it doesn't go great, that's fine. I'm not paying for any of the growth, but my risk is this 100 goes to 90 to 80 to 70 on a structural basis, because that's where I get it wrong. And so the Polaris world, you're always thinking about not what can go right, really what can go wrong. And so when we go out and we meet with companies, and we have discussions with management teams, we don't, by nature we're optimists. We work in a small business. You have to kind of be excited to come to work every day and put on a face of, you want to drive things forward. But when we look at our investments, we always try to think about, okay, what's a downside risk? What's the worst case scenario? How do I make sure that this cash flow is really sustainable? Because that's what I'm paying for. So, we use this framework, or this template, and this financial model for all companies, all industries. And in fact, we have a separate bank model, but we actually also think of financials as just streams of cash flow. And so at a high level, we have a lot of consistency in terms of our thought and the actual way we model these companies. Now, having said that, right, every company and every industry can be different, right? What is maintenance CapEx for, a semiconductor chip company, right, can be very different than an industrial gas company, can be very different for an oil company, right? For an oil company, if you've got a decline rate of, call it 4 or 5% a year on your oil production, right? If you're investing in CapEx, to replace that and just keep that production stable, that CapEx will be considered as maintenance CapEx, right? So that's sort of one example. If you're a software company, right, you might have very little physical CapEx, but let's say, part of the way you're growing, or part of the way you're actually keeping your cash flows constant in real terms, is you're actually going out and buying companies. In that case, basically, all the M&A capital we would consider as maintenance CapEx, right? And so, I think this concept is new to a lot of people. It's very different than we see relative to our peers. From a framework, from a conceptual perspective, it's not rocket science, rather. It's very simple to us, but there's a lot of nuance, and you really have to be very disciplined in terms of how you think about this. And that's where we think about, having investment professionals here, anywhere from 10 to 30 years working in this process. There's just really a lot of IP that you pick up along the way that's important when you execute this process. We might get questions on this in Q&A, and I'll certainly come back to those, because I think, although it's simple, there's definitely some nuances to it. So let's just keep this on the side burner for now. In terms of so we've talked about the numerator. In terms of the denominator, let me just spend a couple of minutes here, because this is really our discount rate in terms of what we're discounting these cash flows back at. And this discount rate, this is something Bernie developed, and this framework he developed 35 years ago. It hasn't changed in the last 35 years. It's not going to change in the next 35 years. We are wedded, very disciplined in following this process. It really has three building blocks, this discount rate. The first is a long-term equity market return. We use 7% real in dollars And the reason we do that is that's what it's been for the last 90 or 100 years, right? We don't want to forecast the future. It might be twice this going forward. It might be half this. It might be negative. We don't know. But we make the default assumption that an equity investor can get 7% real in an index fund. Therefore, at a bare minimum, we have to beat this. Otherwise, we're not adding any value to the investor. So that's kind of the first building block. And think of, for the purpose of this discussion, as sort of a fixed variable. The second component is if I'm trying to beat the benchmark by 200 basis points on an annual basis, and that's one of my return objectives, I have to embed this into my discount rate, right? And so this 2%, this is absolutely set in stone. This hasn't changed in the past. It's not going to change in the future. We want to basically buy companies that are priced to give us 200 basis points or more of excess return. So we embed this into our discount. So 7 plus 2 gets you to 9%. The third component is we have a country risk premium. We are investing anywhere, possibly everywhere in the world, right? But we don't hedge the currency in any market that we participate in. We think hedging currency for us is at best a zero-sum game. But we obviously have to be compensated or compensate our investors for potential foreign exchange risk, depreciation, sovereign risk, et cetera. And so the way we do this is we will look at a local 10-year bond rate minus the CPI to derive a country risk premium, effectively the real yield. And for example, if we are looking at South Africa, right? If the South African bond rate, 10-year bond rate is 10%, and the local CPI is 5%, the country risk premium or the real yield is 5%. 10 minus 5 equals 5. And the reason we use this, and by no means is this perfect, it can certainly change day to day, week to week, and we can see volatility that's exhibited greater than this. But we believe that the fixed income market is probably one of the most efficient markets in the world, okay, at determining what sort of excess return they need to be justified for these various risks. So in the case of South Africa, 7 plus 2 is 9, plus 5, 14% will be the discount rate we use for South Africa. So we've created this 14% discount rate where we have now for South Africa. The last step to this global cost of equity is we then, when we look at a specific company in South Africa, we beta adjust that, right? Because that's the other part of my return objective, having this 2% excess return with a beta of 1 or below on a kind of portfolio basis. And so what that would mean is that, let's say it's a South African company with a beta of 1, okay? In that case, 7 times 1 is 7, plus 2 is 9, plus 5, 14%. 14% would be our discount rate for that company. But let's say it's a higher volatility, a higher beta stock. So and let's say it's 1.5. So 7 times 1.5 is now 10.5, plus 2, 12.5, plus 5, 17.5%. So obviously a much higher discount rate. Meaning that, look, we're willing, okay, to invest in higher beta stocks, but they just have to be excessively cheap, i.e. we use a very high discount rate to justify why they get to the portfolio to compensate us for that incremental level of risk. And so this is the discount rate. Again, it's in a lot of respects, it's really formulaic. It keeps us very grounded. By using this MCF as the numerator and this Polaris global cost of equity, the way I like to think about it or talk about it, in the Polaris world, you get credit for nothing, right? We've got a very conservative, almost no growth assumption in the maintenance cash flow. We've got a double-digit discount rate. That means that there's a very small opportunity set that actually passes this rigorous valuation discipline. But it actually allows us to embed the most margin for error in any of these stocks. And by creating a portfolio with enough of these, we can help deliver the return objective. So that's the last step in the process. And when I sort of give this sort of initial presentation to new audiences, they always say, well, it sounds very quantitative, sounds like there's a lot of math around it. The truth is, that's really the only math. 95% of what we do is bottoms up, fundamental stock picking, right? We have a front-end valuation screen that I'll talk about in a slide or so. From there, we narrow the pool. We do this bottoms up, kick the tires, going out, meeting with management teams, obviously in a pre-COVID world. We can't wait to get back out there on the road, quite frankly, and we've been sort of doing Zoom calls to death. But we're really doing this fundamental analysis just to really determine two things. How sustainable is the cash flow? And what does a company do with the excess cash flow? Because it doesn't help you to buy a company that generates a lot of maintenance cash flow. You buy it cheaply, and then they take all your excess cash flow and they do value destructive activities. There really has to be kind of those two critical legs to the stool to make this work, right? And then from that fundamental analysis, we really create the best risk-adjusted portfolio. We want to have, a nice diversification. We like to think about 15 different industries, 15 different countries, and create this bottoms-up best risk-adjusted portfolio. In terms of, how do we screen the universe? This is what I talked about, this front-end valuation screening methodology, right? So we have a fairly small organization. We've got, I think, 18 total employees here. We've got 9 on the investment team, right? So we want to be really efficient, not only in our time, but identifying companies that have Polaris-style characteristics, right? And the way we do this is we have some front-end screening technology with sort of some proprietary sort of algorithms that we've developed over the years to filter, to help narrow the pool to fish. And, we can run this, we typically run this on a monthly basis, but I can run it from my laptop right here, and I can run it on a daily basis if I choose to do so. But, the point is there are 44,000 companies in the universe. That's the beginning of our screen, right? We have sort of a little bit of a liquidity filter of some market cap cutoff. And then, I've talked about how we value cash flow so much. Well, if you don't produce positive cash flow, if you don't produce positive maintenance cash flow, obviously you're going to fall out of the screen. And so 44,000 companies come down to, call it 18,000 companies. People often, when we talk about the strategy, people often think about, well, they like companies that generate cash flow consistently. They like companies that have low volatility of cash flow. They like companies that are good capital allocators. So they must love quality companies like a Nestle's, for example. And we say, well, look, we love Nestle's. And Nestle's is in this, 18,664 sort of filter set. But the problem with Nestle's is when we go to the next step, saying that, if you're going to use a double-digit discount rate, it means you need to have a maintenance cash flow yield relative to the market cap of greater than 9%. Meaning that Nestle's is a great company, but it's priced that way, right? We can't afford to pay the Nestle price, right? And so what we're really looking for, I think Nestle's maintenance cash flow yield is probably 3 or 4%, right? We need 9%. All right. And so what we're really looking for are companies that have Nestle-style characteristics, right? But for one reason or another, is mispriced by the market to have a MCF yield of 9% or higher. And it might be mispriced because it might be in a sector that's sort of out of favor on a cyclical basis. It might be that it's in a geography, an emerging market, or some geography that's really out of favor. It might be that there's something going on in industry, right, that's disruptive at that given point in time. It might be that it's a small cap company, right? And like the best example of this is, we bought a German company, Simrise. This would have been probably 2008, 2009. That was right after kind of the global financial crisis crash. And at the time, I think the market cap was probably about sub $1 billion. It was kind of a small German flavors and fragrance company like a Givaudan or International Flavor and Fragrance. And all their customers of the world were sort of the Nestle's and the big food companies and the like. And so it had all the stability and all the characteristics of a Nestle-style company, right? But it was small, and it was after the crisis. It was a kind of a recent IPO. And so that was the opportunity for us to basically buy a company that had all the characteristics that we liked, but for one reason or another, the market was mispriced. Anyway, long story short, we continued through the filter. We've got some value trap filters of kind of, maintenance cash flow slope margin. I won't get into too much detail. And then we've got a liquidity constraint. And so this 44,000 companies gets distilled down to, call it 1,600, or call it 2,000 companies at any given point in time, right? Now, the reality is, the equity market's highly efficient. And I would argue that 75% of these companies are cheap, and cheap for a reason. And it's really that other 25%, call it that 500 or so, that we want to spend our time, our waking moments going through each of these companies one by one, trying to identify the best 75 companies to constitute the portfolio. Okay, let me just talk a little bit about the output of the screens. A couple of quick comments here. So we generally tend to have these value clusters, right? And the screens, they can change slowly over time, like depending on how volatile the market is. But quite frankly, there are a lot of repeat offenders in the screens. Companies are in the screen, they stay in the screen, they're cheap, they're going to stay cheap for a reason, and they're probably value traps. You want to avoid those. But the value clusters generally tend to be both geographic and then sector focused. And in terms of sector focus, let me just start with the geographic actually first. You can see, starting left to right, the three most largely represented countries on the value screens are the U.S., China, and Japan. And interestingly enough, those are three markets that we're actually underweight. Despite the fact they've been really well represented on the screen, we're actually underweight, which also speaks to the fact that the screen's just the starting point. It's not the be-all or end-all. It just creates a pool efficient. The real value add is the bottoms-up fundamental analysis. The second dynamic is really through the sectors, right? Again, and this is where we actually do have material exposure. The three most prevalent sectors are consumer discretionary, financials, and industrials. And I guess unsurprisingly, that's where we actually have fairly meaningful sector exposure in the portfolio. Things that we don't generally see a lot in the screens, some of the high quality consumer staples won't be in the screens because they're priced that way, right? And so that might be an area from a valuation perspective we don't see a lot in the screens. Clearly all sort of, the favorite, loved tech companies won't be in the screens because they obviously trade at very high, multiples or low MCF yields. And then you won't see companies that have really inconsistent cash flow generation because one of the things that this sort of screens out a little bit is around cash flow volatility. But this is something, again, we run on a monthly basis. It really creates the pool efficient. Okay, I think what I want to do now is, now that we've covered sort of the process in fairly good detail, we've talked a little bit about how we think, the way we think about companies and value companies is very different relative to traditional value peers. And we've talked about the screening process. If I walk through a couple of examples of two companies in the portfolio, I think it'll really help give you a sense of what we're looking in for in companies, how we're valuing companies, and how we might put a different lens or a different view on a certain stock or a certain sector relative to a lot of investors. The first company I'm going to talk about is Williams Company. We bought this, I think, in the third quarter of last year. The genesis for this idea is there were many sort of what they call midstream, or these energy infrastructure companies coming up on our screens over the past year. And what was interesting is there, a lot of these are master limited partnership MLPs, which can be fairly difficult for institutional investors to own. And there are also a handful of what they call C corps, which Williams is one of, which are actually more interesting to us. And going through kind of the screen of all these midstream companies, there were probably, call it 15 or 20. What became very apparent to me was that Williams really was very different than a lot of these other industrial peers or some of their competitors in the space. And so who is Williams and what do they do? Well, they handle 30% of the natural gas in the United States. And the way they do this is they have, and this is kind of the key asset, they have this Transco pipeline, which is the largest natural gas pipeline along the eastern seaboard that goes all the way from Texas, the Gulf of Mexico, all the way up to mid-Atlantic into the New England states. And this pipeline actually goes two ways. And so you can move gas both north and south, depending on kind of seasons and gas demand and the like. Clearly, something like this, is a very strategic, long life infrastructure asset that produces a lot of cash flow. And, what I particularly liked about this company and where it really differentiated relative to a lot of its peers is the cash flow is very predictable, right? They're moving natural gas, typically to utilities and industrial and commercial customers. And the way they contract this is just on capacity, right? They sell the utility customer saying, we're going to give you, call it, 10 MCF of capacity, whether that customer uses it or not, they're paying for the full 10 MCF. So it's not based on volume. They've just fully sold out the pipeline. They're saying, you want the capacity, you pay the full price, and here it is. And so there's very little volatility in terms of volume because you're just selling capacity. The other thing that's interesting here as well is that their contracts typically have two types. They can either have kind of a regulated rate of return that kind of the Federal Energy Commission can help sort of dictate. In some cases, they're state utility commissions, but it's a very predictable rate of return. Or with some large kind of industrial commercial customers, they can have some really long dated contracts with very tight contractual obligations, typically indexed with some sort of price escalator and the like. And so it's a very predictable stream of cash flow. You compare this as a midstream company to perhaps a company that's another midstream infrastructure company that might be moving oil and oil related products out in the Permian Basin, West Texas, right? That might not be based on capacity, it might be based on volume, right? And volume can kind of go up and down depending on oil prices. And even more so, it might be dependent on basically the value of the product they're moving. So it might be indexed on the price of oil. And given, I think we're all aware, how volatile that can be. It just has two completely different characteristics in terms of the cash flow sustainability or predictability amongst infrastructure companies of one to the other. Williams would sort of sit on the side as being really, really predictable, where some of the other peers might have much greater volatility. But the irony was they were all being valued as being completely unpredictable. And so, why was Williams cheap? And in fact, why was the whole sector cheap? If you kind of go back and you think about what has happened in the energy infrastructure build out in the U.S., these were great stocks for the period of, call it 2000, 2015, because you had essentially the entire replumbing of the U.S. energy network. And the way these stocks were perceived by investors, and as you had all this capacity and growth capex deployed, you had this sort of holy trinity of high dividend paying stocks, right, that were reinvesting a lot into their business, right, and actually funding this through debt capital, okay, in some cases equity capital, and that all worked really, really well till it didn't work anymore. And the reason it stopped working is in 2015, once the oil price crashed, you had some of these companies realize that A, we don't have as much access to capital as we thought, and B, investors saying, wait a sec, this is an unsustainable business model. And what became very apparent to the entire investor community is these are free cash flow negative business models, right? And you had too much capacity, and so all of a sudden these stocks basically came under tremendous pressure. Then you had, over the last 5 or 6 years, you've had transition towards more kind of renewable green energy resources and the like. And so again, not only basically were investor attention diverted away from these traditional energy infrastructure companies, they were focused on solar and wind and companies like NextEra, which we've owned for 15 years. And when we bought it, it was Florida Power and Light. Now it's basically Florida Power and Light, and obviously the biggest renewable portfolio in the U.S., and that's what people are focused on. And then you get a situation where there's an incredible amount of investor apathy in the sector. There's limited differentiation and valuations, despite meaningful differentiations between business models. Essentially, baby out with the bathwater. It didn't matter who you were. If you were in this traditional midstream business, we didn't want to hear about it. But the opportunity that we saw, and we think lies ahead here, is that Williams, and they did have some new management come in, adapted to the reality of the new landscape, said, look, we've built out all infrastructure now, right? There's very little incremental capex that we need to produce, to invest rather. And so what we have is an opportunity for exceptionally strong cash flow generation that you can pay a dividend, you can pay down some debt, you can buy back some stock, and you can invest in some select high return projects. And so when we bought this company in, I think, October 2020, this was roughly, call it a 13% maintenance cash flow yield. And if you slice that up, 8% went to the dividend, call it, maybe another 2% went to debt pay down, maybe another 1% could go to the stock, and maybe another percent or two could go into these high returning brownfield growth projects. And so for us, this was really a very compelling way to get exposure to what we think is an exceptional asset on a very compelling risk return profile. We're often asked about an energy outlook. And quite frankly, we don't have a lot of energy exposure in the portfolio because predictability of the cash flow is really, really hard to determine, right? And we've, have done a lot of work over the years, and because of the advent of shale, and it means that supply can come on and go off very quickly. So we have this determination that oil is going to be in kind of this $30 to $70 environment, for the extended period of time. So we really don't feel like we want to bet on oil companies unless obviously they were priced to, in our world, to give us our required rate of return. We think Williams is a much more intelligent way to get exposure to part of the energy value chain, but with a profile that we like. Maybe I'll just talk about one other example, and then we can spend a little bit of time with a short conclusion and then some Q&A. But I just want to talk about one of the financials, because financials are our largest exposure. And clearly, they've been very much out of favor for many, many years. The one I'll talk about is Bank of Colombia. It is completely unloved. In fact, it has lagged this financial rally. It has really been a poor performer. But having said that, there is a lot to like here. Why do we like it? It's, first of all, it's a leading bank. It is the leading bank, rather, in a consolidated banking market, right? Now, Colombia's kind of got four big banks. Amongst the four of them, there might be a little bit of a smaller fifth player there, but Bank of Colombia has 25% market share in that market. We like Colombia's in terms of its emerging market profile for a lot of reasons. There's still a lot of structural growth in the financial service sector here in Colombia. And you can see on the right-hand side, historically, a lot of their loan portfolio is corporates. But the real opportunity is really around retail and mortgage, as an increasing number of the population continues to enter the banking system and applies for credit. And as you get a continuation of kind of middle, lower to middle class, middle to upper class development, you're going to have growth in that retail side, and that's a nice little tailwind. I think the other thing we like here, they have a very strong and conservative credit culture. This is a family-owned bank, and our experience is, family banks generally care a lot more about taking appropriate risk than someone who's managing a bank as a professional manager that's gets compensated on growth or share options. And so, we've really seen them manage the bank the way we like to see banks managed. And they have a very strong capital position. And, we're a little old-fashioned in this sort of metric. We just like to think about, equity to total assets, and they're greater than 10%. And with a net interest margin of, call it, 5% in any given year, and, net charge also is less than 10%. We think this is, a very well-managed bank. In terms of why it's undervalued, clearly this past year and into 2021, they have been impacted by COVID. Not all. The result has been obviously increased credit losses, some net interest margin pressure. Not all countries have the benefit of the U.S., where you can just put in a massive stimulus package. So, their economy has certainly been under pressure. We've had some weakness in commodity prices over the last couple of years. Look, Colombia is certainly diversifying away from being a commodity-centric market. It's probably, call it 10 or 15% reliant on commodities. As a result, the peso has been under pressure for a number of years. But, we certainly understand 2021 is going to be a transition year, but we're a long-term investor here. These guys have a great long-term history of value creation, despite the fact that EM's been really tough for the last decade or so. Bank of Colombia has a 20-year track record of compounding dollar returns of 20% a year, right? When you look at the valuation here, it's trading at kind of 1x book, and we think kind of when you come out of the credit cycle, you're going to be kind of a mid-teens normalized MCF yield, which we think is really attractive from here. In terms of our financial sector outlook, look, we got a lot of questions about this, particularly last year when financials were so under pressure. Particularly in the third quarter, we went back, looked at every single financial that we owned, and we made a determination, company by company, that these, despite the fact they were underperforming, despite the fact we were getting a lot of calls from investors, these were the best risk-adjusted places to be. The stocks were incredibly cheap. One of the differences from prior sort of banking cycles is they were really well capitalized. It's totally different than 2007 or 2008. Because of both kind of regulatory requirements and because of the fact that banking models have changed. Banks were just in much better position in this crisis relative to the prior crisis. People are obviously very concerned about low interest rates, understandably, but we've been operating in a very low, ultra low interest rate environment for many, many years. And one might argue that if we do get a higher rate environment, that could be incredibly beneficial for these banks. The last couple of things here is that these companies continue to invest in technology. The banking business is changing, branches are closing. We're doing more on digital. People always talk about a lot of threat from fintech, but these companies are adapting and meeting that threat, and in some cases coming up with completely new innovative business models and ways of doing businesses that will really position them well, in fact, lower their cost structure in a lot of respects. And then lastly, and this speaks a little bit to the Bank of Colombia dynamic, is that we are big believers for banks that we prefer slower growth, conservative credit culture. Slow and steady wins the race, because the reality is banking is a commodity business, and if you're growing faster, materially faster than your peers in a banking market, the only way you do that is you're willing to take more risk than the next guy, which is great when things are going well. But when that credit cycle turns and the tide goes out, in the old Buffett adage, you'll see who's swimming naked. So we are much more inclined to basically buy slower growth, more conservative, well-capitalized banks, because what kills you in a financial stock is not that a company under-earns, it's that they have massive credit problems and you're forced to do an equity raise at really dilutive prices. And so that's really how we think about exposure to financials. Really, just to close, and this is time for value. This is probably the billion-dollar question. Who knows? But clearly, we've seen a historic outperformance of growth versus value. Look, a lot of this has been driven by multiple re-rating. Quite frankly, a fair amount, and that's because a low interest rate environment certainly supports growth stocks. Is this gale force headwind shifting to a tailwind? Possibly. But, for us, sure. Would we like a tailwind as opposed to headwind? Sure. But our strategy is not dependent on this change, right? We're long-term, we're patient investors, we're big believers that if a company produces cash flow consistently and does intelligent things with that cash flow, even if public markets don't recognize the value, we as Polaris, as patient investors, will be rewarded. And it might be rewarded by a return of capital, a special dividend, or it might be the case that, private buyers, private equity or strategic buyers might recognize the value, and they'll crystallize this through M&A. And in any given year, we typically have half a dozen companies that are acquired at very attractive prices to us, and also still to the buyer, because the public markets don't recognize the value and someone else does recognize the value. So hopefully that's been a nice introduction to Polaris. I think, Graham, what we can do now is, I certainly appreciate everyone's time, so maybe we can just open it up for some Q&A.
Definitely. And it does look like we do have a couple questions coming in here. First one coming from one of our return viewers, WK here, saying, currently Alibaba looks like high free cash flow, high margin of safety, double-digit discount rate. Do you have any thoughts there?
So this is obviously on the Chinese stock Alibaba. Look, and I could probably pull this up on my computer, but I'm scared of having a technology snafu here. But my guess with Alibaba is probably generates a lot of cash flow. I'm sure it does. Obviously, it is a very high margin, very attractive business model. But my guess is when we run it through our valuation dynamic, I would be surprised if it is greater than a 9% MCF yield. My sense is Alibaba is probably priced to factor in all those really attractive characteristics that the audience rightly identifies. And so I will have a look at it right after. I know we've looked at it in the past. It's just never been cheap enough for us to buy. But we look forward to the day that it is.
For sure. And continuing on here, a question from Robert out in the audience. Would you mind swinging back on the computation of MCAPEX and what your thoughts there are?
Sure. Let me just jump back here. In terms of MCAPEX, so the computation is really a combination of quantitative and qualitative analysis. In a lot of respects, it's backward looking, right? At least as a report card, because the past gives us some semblance of, how close we are or on or off this number. And maybe the way I describe this is, we might sit with a management team and we might pose them and say, look, what do you think your maintenance CapEx is, right? And they may say, well, it's 30 million of maintenance CapEx and 20 million of growth CapEx. And we say, okay, that's interesting. And then we'll look and we'll say, well, you produce 100 million of maintenance cash flow today in cash flow from operations today. And if we look back 5 or 10, let's say 10 years ago, you were producing 100 million of cash flow from operation and inflation adjusted 10 years ago. So there's been no growth in real terms of cash flow, which is fine. But what that also tells us is the entirety of the CapEx in that case, the entire 50 is actually maintenance CapEx, right? They tell us it's 30, but the fact is they haven't grown cash flow in real terms. That's fine, but the entirety of CapEx in that case would be maintenance CapEx. And so a lot of respect, we look at a historical report card to determine, basically, we look at a company's cash flow growth or lack of growth. Either's fine, okay? But from there, we basically, I wouldn't say back solve, but we can really, through both quantitative, qualitative discussions and a lot of, experience and, in-house IP, help tease out that number. And so I know that's kind of a very short explanation to a very good and complicated question. But we could probably spend another hour discussing that. And so maybe I'll just invite the questioner to connect directly with us in Polaris, and I'm happy to go through that in greater detail.
Definitely. And continuing on here, looks like we have some appreciation for a great presentation, and then a question asking, looks like putting you on the spot a little bit here.
Yep.
What have you guys been looking at for average returns over the last 10 years now?
Okay, so in the last 10 years, okay, I don't have my performance number in front of me, and I probably should. Apologies. Probably on a 10-year basis, my guess is we're running up somewhere on 9-ish, 10%. Certainly the last year has obviously been very good as values come back. The prior 3 years, were difficult when that value sort of headwind became a gale force wind. But by and large, up until then, almost under every environment, we were beating the benchmark. I'm not talking about the value benchmark. I'm talking about the benchmark. And we certainly outperformed the value benchmark by a wider margin. So again, we can absolutely get you that data. Apologies. It's usually in our presentation. And that's why, I would happily go through it, but we slimmed down this presentation in the interest of time. But again, we can get that number. We can get all the historical information for the questioner.
Definitely. And just a reminder to those audience members out there is some contact information here on the last slide of the presentation if you do feel like reaching out there. Continuing on to our next question now. If you're taking these long-term positions, approaching a 10-year horizon, how many or how little potentially transactions do you guys think you're making on like a month-to-month basis?
Yeah, good question. And maybe I'll touch on two things here. So there's transactions, and that might be, we're adding or trimming to a position depending on basically the position size and the like. And, and that could vary, depending on market conditions. But maybe the way I'll answer it is really kind of how many new positions we're adding or how many we're exiting, because I think that's really kind of the focus of the question. Generally our historical turnover is anywhere between in sort of 15 or 20%, right? So that means on a 75 stock portfolio, anywhere between, again, 12 to 15 new names per year, right? If we go back to last year, 2020, that was a really active year for us. We actually added, I think, close to 25 new companies to the portfolio. And look, we broadened the number of companies that we held. And the reason why is when we had the massive sell-off in March and April of 2020, there were just so many companies that came into our screens that we've never been able to own that were just incredibly attractive. And so we had this incredible opportunity that we took advantage to step up and buy, really good companies at very attractive prices. If you go back to the prior years of 2019, 18, 17, when there were probably less interesting opportunities, that year we might add 10 new names per year, right? And so on a year-to-year basis, it can definitely fluctuate depending on how volatile the market is and what opportunities we are presented. But I would generally say kind of 15 to 20% as a long-term turnover metric is probably right. And why that's also important is, we're not a firm that's trying to come up with an idea a week, right? We've got 9 investment professionals. If you think about, call it 10 or 15 new stocks a year, that means, someone's coming up with maybe 2 really good ideas a year, right? We only want the best ideas that fit the framework that we work under.
Definitely. And I guess just to expand on that, kind of one of our favorite questions to ask here in these presentations, we hit a lot on, finding opportunities and then buying those opportunities and reaching that decision point. When it comes to selling, is that a hard thing to do within the portfolio, or are you guys happy to kind of trim out positions as need be?
Yeah, great question. So when we buy a company, right, if we're using a 10% discount rate, 7% plus 2, and let's say 1% for a country real yield, that 2% is the excess return, right? When we value a company, and let's say we're using a 10% discount rate for the buy price, at that exact time, we will also value the company minus that 200 basis points of excess return, meaning, once that's been delivered or competed away, i.e. using an 8% discount rate, what's the sell price? So it might be that, value the company, the buy price is $25 using a 10% discount rate. When I use an 8% discount rate, maybe it's $33, right? So from day one, we know at least formulaically, what the buy price should be and what the sell price should be. Now, the reality is what also happens, though, is when we look at a company and we buy it, right, we make these very, benign or even pessimistic cash flow assumptions that are basically used to produce us 25 and 33 kind of pricing. But then when a company reports the numbers, maybe the number isn't 100 of MCF they've delivered, maybe it's 102 that they've delivered, right? Or 103, they've delivered more than we've modeled. So we rebase that, and all of a sudden the buy now becomes 28 and 38, right? And so there's sort of a little bit of this iterative process. If the companies are doing what we think they should do, that the buy and sell price should move up generally over time. When we sell a stock, it's really for 2 reasons. Is if we're dead wrong fundamentally, and those cash flows aren't 100, they're 90, they're 80 on a structural basis, we've made a mistake. We have to admit we've made a mistake. Sell the company. Or the other basically is if the market now prices it so aggressively that it's now pricing it, instead of an 8% discount rate, it's using a 6 or 5, and we just can't basically justify holding the stock because there's really material growth expectations now embedded in that company, and that's really where we sort of pass that along to the growth investment. And the best example of that is Symrise, right? When we bought Symrise, it was a cheap stock no one really paid attention to, and then they started putting up numbers, delivered growth, and eventually, it became too expensive. We said, look, it's time for the growth investors to take the stock, and that's what they do, and this is what we do.
Definitely. And as we're getting towards the end here, we'll go ahead and crank out our last 2 questions here. This first one is your approach on a DCF kind of basis. Do you take into consideration multiples and comps in that approach? And when there's a significant difference, does it concern you there?
Um, Great question again. We don't. The only valuation methodology is this modified DCF. That's the only thing we use, right? So we'll never basically have some sort of blended valuation model where you might use a DCF and you might use a comp or you might some other methodology, right? Now it could be the case, right, if company A is being priced, by the market as requiring a 10% discount rate, and company B, that's a competitor, exact same industry, exact same business, right? It being priced, using a 5% discount rate, i.e. being priced at twice the multiple. We might want to know why. We might want to try to understand, like, fundamentally what's different here between these two companies that has these completely, disparate valuations. But we would never basically, borrow or justify or use a different valuation framework to justify company A. We just want to know, basically, are we missing something between company A and company B that there's such a wide discrepancy in the valuation?
Definitely. So just covering the bases just to make sure.
Yep.
For sure. And to get to our last question here, in selecting a position in Bank of Colombia, did you weigh industrial growth in Colombia versus Mexico, Brazil, etc., things like that?
Yeah, for sure. And I mean, this speaks to probably the comment I made earlier on. We want to be completely agnostic in terms of sector and geography, right? So when we don't try to basically say, well, we want something in emerging market and then we want, something in Mexico or Brazil or Colombia and the like, right? Every single company has to stand on its own merits, right? And so when we looked at Bank of Colombia, we went to Colombia, we visited there, we were on the ground, we did all the research as we've done in Mexico and Brazil and other markets as well. We focused on Bank of Colombia and Colombia, but we would certainly also, when we would look at a Brazilian bank, right, focus, and then we would basically say, okay, are there similarities and differences between these markets in terms of both, economic development, geopolitical, company level, et cetera, and like, because you want to select the stock on its own single merits, but there's also a mosaic that goes around it to understand basically differences, nuances, risk, and the like. And by having a wider spectrum or prism, you can basically take information that will help you make a better single stock decision, if that makes sense.
Absolutely. All right. Well, that will round out our questions today. Thank you to everybody out there in the audience for joining us today and for asking such great questions. If y'all did enjoy the stream today, do please take a moment, go ahead, like the video, put a comment down there, let us know what your favorite part was. It really does help with that YouTube algorithm, really helps these videos get discovered by more people. And if you do want to hang out for more future content, please feel free to subscribe to the channel. Outside of that, there will be a full video recording of this made available here on YouTube as well as on Guru Focus, so you can go back, access all of these slides, things like that, rewatch any parts that you did really enjoy. Jason, it's been an absolute pleasure today. Thank you so much for joining us and taking the time.
Great. And thanks, Graham. Thanks so much for your efforts, and thanks so much for the audience to take an hour out of their day, and certainly very good questions. And please feel free to follow us up with us directly, and we can continue the conversation. So thank you.